All right. Welcome, everyone, and thank you for joining one of a series of interviews we're doing with folks in the industry around the need for capital to spark the climate tech revolution. So for those who don't know me, my name is Christopher Lowell. I'm managing director at InnSure, a nonprofit innovation hub focused on catalyzing a bold insurance industry response to climate change. One of the programs that we help support is something that we call GreenieRE, an attempt to build up a nonprofit reinsurer with a mission to support as many climate-friendly MGAs as possible. With me today, we have James Kench, head of insurance at Kita Insurance. And we're going to get into a good conversation. Thanks for joining. And it should be, 10 to 15 minutes. We'll see.
Yeah, brilliant.
James, thanks so much for joining us today.
My pleasure. Great to be here.
I wanted to start with actually just a little bit about you, sort of your journey and background, just to get the folks to know who they're chatting with.
Yeah, sure. So I'm from the UK, as you can tell, based in the US. Originally was trained as an attorney, went into finance, but escaped into the insurance space, and I spent most of my career there on the insurance broking side with a firm called JLT, and then Marsh McLennan, which is a big US, New York headquartered insurance brokerage, but always in emerging risks, emerging markets, and sort of building out new products, building new stuff. That's my passion. And then originally my undergrad was biology and chemistry. So always been sort of passionate about ecology and the environment. And now finally able to kind of pull all those strings together, working at Kita, focused on the carbon space. So yeah, super happy, super excited, and pleased to support this initiative.
Oh, fantastic. Thank you for that. So can you tell us a little bit more about Kita, both, I guess the origin story and its business model today?
Yeah, sure. So a high level, Kita, we're insurance firm focused on de-risking high quality carbon projects, enabling them to scale. We believe insurance is the key to unlocking the financing that the sector needs. And we think that without insurance, it's hard to get financing, and without financing, then these projects can't get off the ground. When we say carbon, we mean anything that stores carbon from the atmosphere and puts it underground, either through sort of nature, i.e. protecting forests or regrowing forests that have been lost, or sort of engineered carbon capture, things like direct air capture and biochar, enhanced weathering, all these new emerging technologies that hopefully will help us in the long run. The origin story was our three co-founders. The CEO is an American woman. She's in the UK, so we've done a swap. But three co-founders met in the UK. They came through a Cambridge UK climate VC accelerator. They thought they wanted to build a company around carbon removal, like a hard tech company, and they went into the accelerator thinking about that. As they met and as they were discussing that opportunity, they realized that access to financing was a key blocker to do that. And one of the blockers for financing was insurance, and the fact that this is an emerging space. There's very little information data on the risks in the carbon markets, means that naturally all the incumbent insurers, the big household names, are reluctant to kind of dabble in the space. Therefore, there was an opportunity for a new firm that could partner with existing incumbents in this sort of MGA structure to focus purely on this emerging risk, understand it, underwrite it, and build products that could help it to scale.
Fair. Thank you. I feel like I'm going to dive into multiple different parts of your answer. That's all right. So one is, could you just give the folks a little bit, and this is a focus on the voluntary carbon markets. Could you just describe how they operate, who the players are, and then I think what might come out of that is what types of risks are present in these projects that you're helping to de-risk?
Yeah. Okay. Gotcha. So yeah, the carbon markets are emerging. We kind of look at them in sort of four dimensions. There's what you mentioned, there's the voluntary market and the compliance market. So how the trading and the legality around these carbon markets, whether they're regulated or not. So an example in the US would be the sort of Californian cap and trade emissions trading scheme. That would be a regulated market versus a voluntary market. It's just corporates and investors acting without a legal requirement to do so, but trying to do so, to do good and to offset their emissions. So they kind of the regulation dimension. We also think about how the carbon is stored. Like I mentioned earlier, it's either from by nature or through some kind of engineered process. The types of carbon credits that are issued, we think about that in two angles. Either they're credits for tons of carbon that have been avoided from being emitted into the atmosphere, or they're credits from tons of carbon that have been actively removed. And the difference there is that avoidance would be if I've emitted a ton of carbon, I'm paying you not to emit a ton of carbon, then that emission that I would have has been offset, but there still has been 1 ton of additional carbon released into the atmosphere. Whereas a removal ton would be, I've emitted a ton of carbon, I'm going to pay you to remove a ton of carbon, and then that on a net basis means that there's no net increase in carbon in the atmosphere, and that would be sort of the net zero or hopefully net negative angle that the carbon markets are hoping to support. And then lastly, we think about who's active in the space and the different investor profiles. So there's corporates, like I mentioned, that are investing as part of their net zero strategy, and they do everything they can to avoid emitting, they reduce their emissions, and then that last sort of 10% of hard to abate emissions, they want to offset them with carbon credits, and then they want those credits to be the most high quality, durable, permanent credits that are available. And then the other class of sort of main players are sort of an investor stakeholder. So there they see carbon more as an asset class, like another commodity like gold or oil, and looking to build markets, invest on behalf of their own account or on behalf of LPs, etc. But I think it's an interesting space. The voluntary market is fairly nascent. It's estimated at something like $2 billion, give or take, in the last few years of credits that are being issued. The long-term forecasts are that it could be a $1 trillion market just because of the sort of the climate math that is out there and the amount of carbon that needs to be reduced from the atmosphere. I think the forecasts are by 2050 something like 10 gigatons or 10 billion tons of carbon need to be removed per year, and that's just a scale up that's just on the kind of that would put carbon on the same level as the existing commodity markets. Coal is like an 8 billion ton market, so it's a real massive scale up that needs to be driven, and we need the financing to get there, and hopefully insurance can play a part. You mentioned, I think the second part was on the risks that we see in carbon markets. I think a bit like any asset class or any any type of business, there's all the traditional risk that you would see both in the physical assets and some of the legal liabilities. And I think we see opportunity there for insurance to play. The classic business package, directors and officers, general liability type covers. I think the nuance for carbon would be there are some physical risks around the carbon projects themselves. So if it's nature based, then the forests have susceptibility to wildfire, drought, pest, disease. If it's an engineered project, then that would be a bit more like a typical kind of manufacturing plant, perhaps exposure. So you have the construction risks and the ongoing operational risks. Then on the liability side, maybe the key risk is around environmental liability. People are thinking now and trying to get our heads around, once you capture this carbon and you store it, what happens if there's a leak? What happens if there's a leak and that causes damage or impact to the environment or to the local community? So that there's a lot of research and development going into that space, particularly around things like geological storage for direct air capture or carbon capture and underground utilization and storage. And then where we come in is more on that intangible element. So that the tangible risks, I think, a bit more apparent to the insurance industry. The intangible risk is more around the risk to the carbon credits. We focus on the credits because we think they're the main mechanism to drive the financing into the markets. And those risks are mainly credit, like traditional credit risks. So things like counterparty risk. There's political risk as well. A lot of these projects are in emerging markets in the global south. There are physical risks that are that kind of feed into the value and existence or you know, presence of these credits as well. And so it's a slightly kind of derivative level risk, and we're looking at the life cycle of a credit, the different stakeholders that play, and the different types of carbon projects that are out there, and trying to focus on what are those pain points around those a bit more intangible risks that need a real bespoke, dedicated insurance proposition that can help de-risk it and allow investors and the stakeholders to operate safely with a bit more certainty.
Got it. And so I loved your phrase you used at the beginning of this conversation. Some of the larger players are reluctant to dabble. What has been both? I mean, Kita is a live product now, so you did find capacity and capital.
Yep.
What was the experience or journey from Kita's perspective, and if there's a way to touch upon what would it have meant if there was actually a GreenieRE type solution out there that was, shall we say, just a little bit more yes forward on covering these risks? What would that look like?
Yeah, so I think we had a good experience. It's trying to innovate in both a new product and in a new market. So there's sort of two dimensions of innovation and challenges that we had to get over as hurdles from the insurance industry. I think we were fortunate in that we came through this Lloyd's of London Innovation Lab in the UK, and there they've set aside a small percentage, 2% of the overall premium into what they call the innovation class code. So they're trying to lower those hurdles a bit, embrace innovation, embrace the ability to take risks, but in a sort of more kind of proof of concept environment. And that worked for us. And thereby we can partner with bringing our expertise and focus on the carbon markets and really understanding the emerging risks and working with our insurance partners to translate that into proper, reliable, robust insurance products with the right procedures, protocols, reserving, claims process, all that stuff that you would expect, as well as the investment grade, good capacity behind us. That was a good experience. I think then the challenge is then how do you keep iterating on that? How do you scale that up? And as we see the carbon markets are evolving very quickly, the potential for growth is pretty massive. And on the buy side, the investors and the stakeholders who are getting into the carbon markets are coming in quite large numbers and in large investment vehicles and structures. So we were kind of set up to focus on kind of smaller to mid cap opportunities, maybe a 5 million, 10 million transaction. What we're seeing is that some of the big institutional investors are coming in. They're looking at it at sort of portfolios of risks or really large funds that are over the next few years looking at hundreds of millions, if not billions, of investment dollars, all of which they're looking to the insurance industry for risk solutions in order to make it bankable and investable for them. So I think definitely there's opportunities in the short, medium, and long term that needs dedicated climate forward, positive, innovation friendly risk capital. And I think GreenieRE would be just a fantastic example of that.
That's great. Thank you so much. I want to wrap this up for our listeners and for you. Are there any other thoughts or comments you want to share?
Yeah, I think the only thing, in the climate space, we think insurance has a key role in de-risking the carbon markets, but also just adding extra layers of due diligence, extra stamp of quality, and also just proper risk management, both proactive and reactive, building back better, building better climate resilience and adaptation. And I think that applies to maybe any climate sector, but it's definitely going to apply to the carbon space because it's so emerging and nascent. There's lots of great technologists, investors, financiers in this space, but there's still a relatively modest, understanding of risk and climate risk. And I think that's where the insurance industry can really pack a punch pretty quickly and help up everyone's game and de-risk the whole marketplace at the same time.
Well, that's fair. Thank you. And James, thank you so much for coming on and sharing both your journey, Kita's story, and your perspective and expertise. Really appreciate it.
Yeah, brilliant. Thanks, Chris.